Is a 1,400% return good? Well, that depends on the time frame. In this case, we're talking about 2 decades, and you need to compare that return to a relevant benchmark. We're going to do that today. But when you consider any return, you need to consider the risk that you took. So when you're able to achieve a 1,400% return in 20 years, when you're invested in a Dividend King, that's a company that has increased their dividends for at least 50 years or more. That's pretty good because you took low risk for high return. In this case, we're talking about an industrials company that's not only paid a dividend but increased it for 68 years in a row. And when we look at industrials, so this is the Vanguard Industrials ETF. It looks at the largest industrials companies out there. So businesses in the industrial goods sector, they make and sell machinery, equipment, and supplies used to produce other goods rather than sold directly to consumers. So they have the advantage of avoiding all the class action lawsuits that took down 3M, for example, or have threatened Johnson & Johnson. So what's interesting about this list of companies, so there's some names we're probably all familiar with at the top: General Electric, a brand that's persisted over the years. Caterpillar, that's a great industrials company. It happens to be the only one in this list that we're invested in, though we also hold 4 other industrial companies. But the company we're going to talk about today doesn't appear to be on this list because its market cap is quite small. Well, relatively small. It's $74 billion. Now, before we get to talking about today's company, I wanted to point to something very interesting. You may have questioned why Uber Technologies is in this industrials ETF, and this was the result of a change that took place, I think it was in 2022, where MSCI and S&P decided that the trucking sub-industry should be split into 2 new sub-industries, one called passenger ground transportation, and that's where Uber was placed. So this is rather interesting because now their peer comparisons, when you consider a company's executive team and how much they're paid, they'll typically take a look at peers. So now they're being compared to peers in industrials as opposed to tech. So I'm not sure that makes their C-suite very happy, but I thought that was an interesting side note here on how Uber is classified as an industrials company. So the company we're going to talk about today, Parker-Hannifin, they had annual sales in 2023 of $19 billion, so they're rather large in Fortune 250. As I said, $74 billion market cap or so. They talk about being a global leader in motion and control technologies. We're going to talk about that. You can see they're more than 100 years old, so they've been around for a while. They talk about consistently delivering strong shareholder returns. Well, when you're able to increase your dividend for 68 consecutive years, that by definition means that you're consistent, right? They're among the top 5 longest running dividend increase records in the S&P 500 index. Now, one thing to note on Dividend Kings, unfortunately, several fell recently, one being 3M. As I said, that was because of the class action lawsuits they didn't handle very well. It devastated that pinnacle of American innovation. And then there was also Leggett & Platt. Well, that company flies under our radar, but they also lost their Dividend King status. So there's certainly no immunity for companies that have long track records, but as you'll see today, Parker-Hannifin is in a very good position to continue increasing their dividend over time. Now, when you look at their investor deck here, one of the first slides talks about that number 1 position in motion and control, $135 billion opportunity, which we'll talk about. Operations in 45 countries, so they have international revenues, which we like to see. They talk about this leadership position, 13% market share in a $135 billion industry or theme, and that doesn't really add up when you do the math, but they still are a leader with a goal to reach 20%. They have a decentralized operating structure, which we like. So when you acquire a company, and they often do, you don't want to disrupt what's working well, so you keep it decentralized. And they've done that. They've actually went from 130 subsidiaries to 95. So it's a big collection of companies. And
that's good because then those become interchangeable parts. So if a company isn't doing so well, you can sell it to a private equity firm, or you can buy it, replace it with something else. So you can manage a portfolio of companies. They talk about being great generators and deployers of cash. We're going to talk about that. And then throughout their deck, it starts to give you a rather cultish feel. Their win strategy sounds like something out of Office Space, but it makes some sense. So here you can see the 4 pillars of this strategy, and they talk about their goals for each. So this 0 defects idea and continuous improvement, what the Japanese call Kaizen, that's certainly something that stands out in terms of continuous improvement. Talk about on-time deliveries. This measure here, number 1, number 2 position in each business they operate in. That's good to see. We want to invest in leaders. And then you can see all the financial performance metrics there on the right-hand side. Now, you see again here at the top, they say number 1 motion and control company. And here we see they have that $135 billion TAM. And there they are. They have the largest chunk of the pie, but it's highly fragmented. So that means that through selective acquisitions, they can then consolidate this space and increase their leadership. But the math isn't adding up. So if you take 13% of $135 billion, somewhere around $17 billion, well, that's more than the total amount of revenues they had in 2022. When they produced this slide, that was in 2023. So perhaps some of that addressable market is blue ocean, meaning it hasn't been captured yet. But throughout this rather boring investment deck, there are certainly questions raised. For example, here you can see motion systems and flow and process control. This was in an appendix, and you see that collectively, that accounts for less than half of their total revenues. Then you have filtration and engineered materials and aerospace. So the extent to which motion and control goes across their various segments, you see here it does cross over aerospace. So when you start digging through what they do, it's very tough to aggregate 95 subsidiaries and describe that as a collective group, which is what they're attempting to do. So before we get into talking about revenue segments, I just wanted to touch on a glitch we had. So we have a free newsletter that helps people become better investors. We had thousands of people from YouTube sign up for that, and there was a glitch, and they didn't actually receive the newsletter. That's now been fixed. So we fixed the glitch, and it'll sort itself out now. So I'm going to put a link to our newsletter in the description of this video or in the comment section. Please subscribe to our newsletter and help support our work. So when we look at segment performance for Parker-Hannifin, you see here they've broken it down, as we saw earlier, into 3 chunks. You have Diversified Industrial North America, Diversified Industrial International, and then Aerospace Systems. And this is a nice slide showing the sales growth for each. Organic growth is what we would be focused on. You see Aerospace Systems did quite well, also had a nice margin expansion there, and then they provide some commentary. So if you're an investor, you might look at this once a year. I don't think we've looked at what Parker-Hannifin has been up to probably for over a decade now. It's just, this is one of those set it and forget it positions. Now, one of the things they've been doing here is making selective acquisitions. I thought this was interesting, where they show you the deal multiple, so the value that they're getting from these deals, and that takes into account synergies. These are things that are easily put down on paper, but actually realizing synergies is very difficult. I think one study showed that certainly, I think 3/4 of the time, companies don't actually realize the synergies that they think they will. So it's great to see them talk about this and say, yes, we actually realize their synergies. That last acquisition, Meggitt, that almost doubled their aerospace and defense sales, which is rather interesting. And they talk about how in fiscal 2023, when industrial growth was modest, their aerospace business benefited from the continuing post-pandemic rebound in the aerospace market, which is great to see. I'm not sure that will persist. You know, the old joke, how do you become a millionaire? Well, you invest $1 billion in an airline. So I've never been a huge fan of investing in airlines. Certainly, there's a liability component of that, but they seem to be rather bullish on that. They identify it as one of the growth opportunities for the business. You see alongside digital and electrification. They have a slide which shows how the amount of components they can sell to an electric vehicle doubles versus a gas-powered vehicle. And of course, clean technology, I think they say 2/3 of our product offerings are related to somehow clean technology. And then when we look at this other, you'll see these slogans and such trademarked throughout their investor deck, meaning if you work there, as I said, probably some elements of a cultish corporate environment where people always talk about this stuff. How effective is it? Well, that's evidence in how well this company has performed, right? So it's not just lip service, but they talk about simple by design. And here's the one mention in their deck of AI. This was last year, so hopefully they're utilizing that to add value. I imagine all companies will be eventually. Now, how did we come across Parker-Hannifin? Well, we have an objective dividend growth investing strategy called Quantigence, and here you can see a chunk of the industrials companies. There's quite a few. These are all champions, meaning they've increased their dividend for at least 25 years in a row. Parker-Hannifin there sitting towards the top. You'll see it's being penalized on yield, so it would have a much higher Q score were it not for their low yield. The current yield right now is 1.19%, and I'll see people scoff at that. But what you need to pay attention to is the growth of that yield. So you can see here over time, people will often say, well, I'm not going to invest in a particular company unless the yield goes above, let's say, 3%. Well, very rarely does that happen for Parker-Hannifin. You can see here during the Rona, it breached 3% as the market collectively collapsed for a very short period of time. But their yield for Parker-Hannifin, their yield seems to float between 1 and 2%. But when you look at the growth, it's rather strong. So here's the last 5 years of growth. They just last month announced a 10% increase, so this chart would change between 2023 and 2024. There would be 10%. What it collectively amounts to is a 10-year growth rate of 12.4%. So let's assume your yield starts at 1.5%. So you say, oh, that's a very small yield. I'm going to invest in a quality company anyway. So you invest, and your yield is at 1.5%. So here's a question. What would that yield on cost be in a decade at a 12.4% growth rate? So here on the right, you could see a table there, Y10. So starting from Y0 at 1.5%, we simply increase that by 12.4% going forward. After a decade, you'd have 4.8% yield on your original investment. So that's a pretty decent yield, but if you wait one more decade at that same growth rate, you're then getting 16% yield on your original money. It's rather remarkable how dividend growth over time will result in a lot of income, and that's what you need to pay attention to. And when you think about the sustainability of that income, I liked this slide from Parker. It shows the 6-year period, so 2022 to 2027, and the potential $30 billion in capital they plan to deploy. And you see here, there's the Meggitt acquisition, which they took on some debt, and they're paying that down because they have strong cash flows. They're able to do that. They repurchased some shares, some CapEx there, and there's dividends at $5 billion. And they say here, their goal is to maintain their record, of course, right? One would hope that's at the top of their list of priorities, and target a 5-year average payout ratio of 30 to 35% of net income. So as long as they're able to do that then, and the idea there is they want to keep that payout ratio low because they want to grow this business. It's relatively small at $70 billion, and there's, as we looked at, a very fragmented space where they can grow through acquisition. So they want to use their capital to grow that way as opposed to just organically and maintain that track record. So we like that approach of them focusing on growing the business as well as growing their dividend, and they've been doing a very good job of that. What we haven't even talked about is the share price appreciation. So we've only looked at the income component of that total return. Well, let's look at the share price. So this chart here, just taken from Yahoo Finances, to look at their 20-year performance. We think about, all right, they have a 20-year return of close to 1,400%. Now, intuitively, that sounds big, but we always need to use a benchmark. So let's look at NASDAQ. Over that same time frame, NASDAQ returned 721%. So they absolutely trounced NASDAQ. It's rather interesting. Just holding a simple NASDAQ tracker ETF over the last several decades, you have gotten 7 times your money. So everybody that's trying to stock pick, just remember that's the bench. This is the sort of benchmark you need to beat. Well, we can also look at a more appropriate benchmark, which would be the S&P 500, and that only returned around 382%. And if we look at an even more appropriate benchmark, that would be the Vanguard Industrials ETF, and that happened to return about 413%. So by all measures, Parker-Hannifin absolutely destroyed any appropriate benchmark in terms of their return. And at the same time, if you were taking that dividend and reinvesting it using what they call a drip, you'd be faring pretty well over time, which is what we do. And it's why Parker-Hannifin ended up being our largest position in our 30-stock DGI portfolio. That's after we trimmed it. I think we trimmed it at about 10% because it had gone above 5%. So in a 30-stock portfolio, we want to try to keep equal weights as much as we can. That won't happen because stock prices change, but anything that drifts above 5%, we usually start paying attention to that, and we'll trim it and allocate that money into other champions within our portfolio. So it's been one of our strongest performing DGI stocks. Seems highly likely to maintain their track record. Of course, as I said, lots of room to grow in a fragmented space. So we're going to check back in a decade, set it and forget it. Just remember that boring stocks often fly under the radar of today's investors. So having an objective methodology for stock selection can be very useful. Now, I'm going to go ahead and leave you with a video here. If you're thinking about building your own dividend portfolio, then this is one to watch. Thanks so much for taking the time to watch this video today.